Association webinar on managing cash flow fluctuations in turbulent times. I'm Beth Spriggs, HFA COO, and I'll be your moderator today. So whether you're navigating unpredictable sales cycles, managing higher inventory costs, facing unexpected expenses, today's session will be packed with expert advice to help you build more financial stability and resilience in your retail business. So before we get started, just a few quick housekeeping notes. This webinar is recorded and will be available on demand at myhfa.org/webinar. If you have questions, please use the Q&A button at the bottom of the screen. We will answer as many as time allows. And I want to give a shout out to Synchrony, our education thought leader sponsor, for their dedication to the industry and support of these webinars. So let's start by meeting our panelists. First, we have Seth Aronson, CEO of Lax Furniture, where he leads the company to achieve full debt elimination and long-term financial agility. He's also HFA's 2025 Retailer of the Year. Also joining us is Jared Simon, Vice President of Sales and Marketing at Simon's Furniture, and serves on the HFA board as treasurer. Jared oversees financial planning for both his retail business and our association. Next is Bailey Waldrop Walters, CFO of Miller Waldrop Furniture, who has helped her multi-location business remain liquid and strategically grow during uncertain times through proactive cash forecasting. Finally, we welcome Dimitri Goikiman, Managing Partner of Dimitri Goikiman CPA PC, whose team works closely with retailers like Emma Mason and Unlimited Furniture to manage cash flows, secure capital, and optimize profitability. So we have a wonderful panel of experts in this area. I'm excited to dig in and ask questions and learn from the experience that you all have. So let's get started. We'll set the stage with an opening question here. Just toss this out to anyone who wants to begin. What are some of the most common causes of cash flow fluctuations that furniture retailers face today?
I'll start off because we have a unique situation where we are primarily a special order furniture business. So one of our largest effects on our cash flow is not actually sales, but customer deposits and the remaining amount to collect when an order is eventually delivered. So one of our things is that when customers originally place their deposits, they may place a 25 to 50% deposit, and we receive that cash up front. But our cash does not go out until after the furniture is delivered. If you have a higher percentage of customers that paid in full early, though, when you deliver the furniture, you're not going to actually be receiving any cash into the business. You're going to be then paying your suppliers out. So one of our big things is always watching how much customer deposits we have and what is the amount of percentage of that future sales already have the down payments allocated to them. So we can kind of project. We might have a good month that shows profitability, but our cash flow could be negative if we're delivering and not writing new business.
And that's actually one of the biggest issues that I've seen with a lot of clients is they intermingle their deposits with their operating funds, right? So let's use an example of you sell something for 10,000, your cost is 3. They get a deposit for 5. They're spending that 5 on whatever else they need to spend, as opposed to saying, wait, that 3 is cost of goods sold. Let me put that aside. That shouldn't be part of my day-to-day operations. And so, what ends up happening is you get a lot of deposits. You have a great month. You're like, I have 100,000, I have $1 million in the bank account. Oh, this is great. We don't have to pay. You don't have any bills coming out. Let's spend money on a bunch of advertisement. Let's spend money on, redoing the showroom, right? And then 2 months later, furniture comes in, you've gotten all the cash in, as Jared said, but now you don't have the cash to pay your vendors for the furniture, or you're trying to sell and get other deposits to pay for that, and you end up getting to the situation of I don't want to say this that way, but like robbing Peter to pay Paul, and it just continues cycle. So my recommendation note is always keep the cost of goods sold as a separate line item. Put it aside. Don't treat it as part of your cash flow. Have it, break it up. And then you kind of know what your true spend is and whether or not you're profitable or not.
I would add too that it can be more dangerous as your sales, if sales are increasing, it doesn't necessarily become a problem because you're constantly getting more
Yeah.
customer deposits. But in the current macro environment where consumer confidence is up and down and people are, a little bit more cautious with their dollars, even a small sales decline could result in a massive cash flow situation. So that's, something that can get worse if you're already starting to see that you're robbing Peter to pay Paul. You may see that spiral very quickly, especially if you have a small sales decline.
Correct. And also because if you're not reporting it internally to see it that way, you don't know that that's an issue, right? That's kind of the biggest problem. Everybody runs it as one, let's say P&L or one statement of cash flow without actually breaking out deposits and, and future cost of goods sold, because a lot of the smaller retailers, they'll run on cash, right? They won't run on an accrual basis because they don't have the finance department, they don't have the people to actually track it. And so they're not matching their money into versus what's going to come out. And if you have a long enough of a lead time, in most cases, 6 weeks, but what happens if you have a 3 or 4 month lead time on, let's say, furniture or something? And you're paying your vendor way, significantly later, you don't remember this anymore. And then that creates this dangerous cycle of you kind of not knowing, based on your numbers, what's going on.
Another perspective that I'd like to add, well, certainly inventory flow, because it's one of our biggest expenses in this industry, is a big driver of fluctuation, as y'all are describing. I think another thing that people should pay attention to are things like maintenance expenses that are unexpected. So like if you have an AC that goes out in a building that you're in, that can be an unexpected cost that you have to deal with quickly. Typically, that can really, depending on your cash position, can really impact and fluctuate what you have available. Renewals for things like business insurance, if you're not prepared for those things, you could see an unexpected increase that you haven't planned for. And those are important things to be kind of trying to think forward on a little bit more, because those aren't the day-to-day trying to sell furniture, get it delivered, but they are things that can make a big impact on your cash if you're not prepared for it.
Seth,
Yeah,
I think
I'll
that was a shot right at me because I had 2 zones out of 10 that are out for AC today. So I just had to make the fateful call that it's time for AC maintenance.
I'm dealing with that firsthand right now too, so I understand.
Yeah, that's the worst. Yeah, I'll add to what you're saying, Seth. I think especially some of us smaller retailers that don't get to have people on staff that have specific financial knowledge. I think that we forget to look at the cash flow statement sometimes. I think we get really caught on the P&L and we see that we have income, but we're not looking at the cash flow statement to see what some of those after income cash flows are. So you named some good ones, Seth. I'll also add property taxes in there as well. That's one that comes up once a year for us that we have to for sure plan for, and it hits us big time.
Yeah, and in Texas, we have to pay sales tax to the state. So that's
Yeah.
the big
hmm
fluctuation for us, depending on how much we've sold previous to that. It can be an unexpected, expense that not unexpected that we know that we have to pay it, but how much
Right.
it's going to be, can be a big driver on how it impacts cash. And I don't know that smaller retailers, if they don't have the personnel, that they necessarily even have a cash flow, statement or projection. And I think that's a tool that probably we'll talk about more in the meeting today.
Yeah, and that's one of the things if you can, like during the pandemic when it first started, we monitor our cash flow, but when the pandemic happened back in 2020, the one of the first things we looked at was where did all the cash go out in the last 90 days? Just take a listing of every withdrawal from every bank account to see where the money was going. Not that it was a crisis, but we wanted to get a really good picture of where every dollar went and what we can, cut off to improve cash flow in a situation like that.
The
Yeah.
other thing that I've noticed is a lot of the smaller retailers don't know how to use their software, right? Almost everybody probably uses QuickBooks, at least on the smaller side, and they look at it the wrong way, right? You can actually use it to track your flow of expenses and things like that. People run their P&L, they run their cash flow, they run it, for the 6 months, for the year. They don't run a by month, 2 or 3 year comparison, which it could do. It's literally a button on top. You select, by month. And now you can see, by category, let's say if you're looking at your P&L or whatever, what the spend was in a specific month. And okay, my real estate taxes were $20,000 in June of 22. They were 21,000 in June of 23. They were 22 and 24. I can now pull this into Excel, for example, add another column and say, okay, based on this, it's increasing 5% a year. In June of 25, I'm going to owe, 24,000, for example, or whatever, right? And it's a very simple thing that people don't actually do because they don't realize that you can run reports on a much more granular level, which will kind of show you your spikes. And you can run it by numbers, you can run it by percentages. There's a lot of different features that are already there that people just don't, they do the basic three buttons, P&L, balance sheet, statement of cash flows, for the year or up to date or whatever the drop down, but they don't actually go and ask for it on a granular level, which is very easy to do.
Yeah,
an
I
interesting
think to the
point.
point of that, there's, the cash flow is the most important part of your financials. The P&L, there's so many things in your P&L that don't necessarily represent your right here, right now reality. So if
Yep.
you're not managing the cash flow itself, that's where you can get into trouble because you can have plenty of non-cash expenses or even things on the P&L that add to, profits that don't really have any cash. It's not really a cash event. And so if you're running your business based on your P&L and you don't have a whole lot of cash, you're really at risk of not understanding how this is going to flow out over a period of time.
Correct. People look at their profit. They look at one number. Oh, I have a profit of this. And they think that that's really the cash, or they think that's really what they have to work with. They're forgetting it's like the common scenario. Clients say, why am I paying tax? I don't have any money in the bank account. And I say, well, you're showing up, you have $1 million of profit on the P&L, but you did all these capital improvements, which are cash flow out, but are not necessarily direct P&L expenses in the current year.
Right.
Or, some of the bigger, like say manufacturer clients, they'll go out and they'll buy a bunch of inventory, right? And it's the same thing for furniture. You bought a bunch of inventory, you have $1 million of inventory sitting on the books on the balance sheet, you have $1 million of profit showing in the P&L, and you have no money to pay anybody because you're out of cash.
Yes, so I was thinking of the same example of purchasing a car or a truck for your granted, there's depreciation laws are always changing under the current tax code and tax bill. But if you go out and buy a truck and you pay for it in full in cash, depending on what depreciation you could take, I believe they're still accelerated at 60% this year.
Yep.
But that means that you could pay out all the cash, show a profit on your books, and then not have cash to pay your taxes in
Correct.
April. So you have to be really cautious about that, specifically with large cash purchases. And that's where sometimes it's even at higher interest rates, it's worthwhile to look at based on your cash flow projections, whether you should look at financing a piece of equipment like that versus paying out of your cash flow. Because even though interest rates are higher, having to do emergency borrowing or drawing on a line of credit could be a higher interest rate than what you're seeing if you're doing an asset-backed loan on like a truck or equipment like that. But remember that when you take on debt, it is sucking your cash flow, not just today, but forever going forward until that debt's paid off. So it's not necessarily, you're still going to pay it. It's just going to be over time now. So you got to remember that if your cash flow was looking tight to begin with and you decide to borrow, it's going to be even tighter because you're going to have to pay those out.
Yeah.
And hitting on the actual line of credit, right, that you brought up, a lot of businesses, what I noticed, they don't take the money when they don't need it, right? And I know it sounds weird, but that's the common thing. The banks will give you money when you don't need it. They won't give it to you when you need it, right?
Really.
So the recommendation I always tell clients, you're having a great year, you have a lot of cash in the bank, go get a line of credit. Get something that you can draw on that has maybe a few years without like a reevaluation. Um, and then you have it as an emergency, right? Because what ends up happening is you have a scenario where your cash flow dips, you need cash right away, but it takes time to get a line of credit, especially as something that's meaningful, right? We're not talking about 50 or $100,000, but if you want to get a normal line, that process takes a few months. And so the biggest thing I see is people get very comfortable. They feel like their business is doing well and they don't get one. I have clients that have line of credits that they have never used and they keep increasing them every year, right? Every year they get it, they reevaluate and they're like, oh, let's get it up. We can take it, increase it 100 grand. Let's increase it 100 grand. They have it. It's an emergency, but it's an emergency that's good to have because when you need it, you're not going to get it.
Yeah, but
I,
that is very interesting, a really good tip. I'm hearing a lot of blind spots mentioned to have people watch out for, different things of even just down to training and things you need to pay attention to just to be aware. And some of these sound predictable, and some of these that I'm hearing sound like they could be a little unpredictable. And I love that last tip on just being ready for some of that unpredictable. But are there, just question for any of you, are there any emerging trends that you might be seeing that could cause some volatility that might lead to some things that some of that unpredictableness that people should watch out for?
I I think the biggest thing right now in the furniture industry is affecting those that import containers directly and are the importer of record, because you're liable for the tariff rate at whatever it is at that time. So if you're buying containers directly from Vietnam, from China, or Thailand, or wherever products are coming in from, if you're the importer of record, even if you're buying through another company that's handling manufacturing, you could be responsible for tariffs, and those tariff rates have been going up or down or all around lately. So one of the ways that you can kind of mitigate that a little bit, which some manufacturers have been uh, doing, is have them as the importer of record, and they'll surcharge you an amount of the tariff, which sometimes can be a little bit lower because the distributor will pay less for the merchandise than you would, and you'd get tariffed at the full amount. That helps make it a little bit more predictable and a little bit lower, but that's a major risk if you're all of a sudden get hit with a 25% tariff on goods that are coming in on a container, and some may be sold at a lower retail price than you would price them at now, which is reminiscent of the inflation of the 2020s, when we had retroactive price increases in the furniture business.
I think another trend that I think we're going to start seeing more of is increase in shipping for those that are flying containers, as the supply and demand in that particular space is kind of subject to all the volatility because of the tariffs and what is shipping and what isn't, and how many freight liners there are available. So I think that's something that you should pay attention to. Is there going to be a spike in container shipping costs?
All right, so we're already getting just so many good tips, you guys. We started off strong. I really appreciate this. And cash flow reigns supreme. That is what we need to pay attention to. But it can be stressful, and we don't want financial stress on us. So are there any proactive steps that we can take to reduce financial stress and create that stability? And Dimitri, I heard you just give a really good one on kind of getting that early, get that early line of credit ahead of time, which I think is a great way to kind of reduce some of that financial stress in advance. Just wondering if there's any other proactive steps that someone might be able to take to help reduce some of that stress and create stability.
Forecasting is a simple one, right? Kind of
Yes.
it's the most missed and simplest thing to do, especially if your business has been around for a few years, right? Most stores have some sort of point of sale system. You can run that daily by, you know, furniture type or by SKU or by whatever you want, and you can run it across multiple years. You can throw it into an Excel and just do a simple little formula that says, okay, we sell this on this month and this date, and then just kind of understand, okay, this was a weekend the prior year, and know kind of how things work. And then going a little bit crazier to that is you can go in and Google the weather in your zip code for those 3 years to also understand what the weather was like, and then you can and then add another type of thing of whether or not there was something happening or whatever else to kind of understand your spikes and your and anything else, and what happens if you're not selling, right? And based on that, a lot of people take into account, it's a holiday, I'm going to try to push a sale. But one of the best, like we used to do, we had a consultant for one of our clients who now consults for, he's like head of growth at Apple, right? And he used to do a lot of retail, and he never looked at holidays or anything else for pushing sales. He looked at the prior year 2 month or the prior week, or sales in that year, right? So if you were down, he's pushing a sale because of that, or he's pushing something because you're down, not because it's a holiday, because it's an expected thing, right? And the other thing is with salespeople, he created a very, you can create a very good system of, commissions or something like that if you need that, right? So have it in your back pocket of, we're down, we need to sell. Okay, maybe I'll pay a little more, but my guys are going to push through and try to get a lot more out, right? So that's kind of the biggest thing that I see that people don't do, is kind of the same thing what I said with QuickBooks, right? Not running it by month is the same thing, not actually knowing why your sales are the way they are.
Yep.
One of the,
I think it's about sorry, Seth.
go ahead, Dave.
I think it's about having a game plan. I think Dimitri said it well. When times are good, that's the time to really plan for when times are bad. Unfortunately, a lot of us right now are in the thick of the fire, but it's never too late to start getting a hold of our expenses. And so knowing what our committed costs are versus our discretionary expenses, we keep a spreadsheet of all of our discretionary expenses, and we have like a timeline for, okay, if sales don't start increasing, or they keep on this path, then we know exactly like where to go to cut. And so I think being able to stay agile is super important. And it's something that we have had to do since our inception, way before I was born in 1952, because we are in an economy of oil and gas. And so we know the ups and downs probably better than anyone. I'm sure there's other volatile economic industries that other people are dealing with, but as oil and gas goes, so do we go. And so we've been riding the boom and the bust since we've opened our doors. And so we've had to be really careful about the expenses that we commit to, that are contract based, that are salaries, and really build a system where we can cut quickly. One of the ways that we do that is our salary programs for our managers. Our managers are used to this boom and bust economy, because if they're not working for us, they're working in the oil field, and this is how everyone goes. But we have a decent salary program, but where they really can make some money is their bonus program. And so when we're doing really well, they make really good money. And when we're not doing well, I still think they make good money, but I wouldn't say it's really good money. But they know this. They know that's how our business goes. They get paid as the economy goes and as our sales go. And that helps us with cash flows a little bit, just to be planning around those boom and bust cycles, but also to really have a handle on what is our committed expenses versus our discretionary.
I think that's an awesome idea, to have a sort of projection of discretionary spend that you can cut back on. But like Dimitri was saying, in terms of projections, what we do that's really useful for us, and is a big tool for us to pay down the long-standing debt, is we run a 13-week cash flow projection. And so that basically breaks down all the cash we expect to come in. So there's a projection of sales and the cash associated with that. We also do some in-house credit. So there's receipts on collections for in-house credit. And then all the disbursements that we project by week, we do it for 13 weeks. That can be shifted for a business, but it really breaks down what are your big line item cash expenses that you're projecting over that period of time. And if you do that, you'll start to see, where you are in cash today and where you project it to change over that period of time. And by not projecting 6 months out or a year out, it's a limited scope. It's about a quarter ahead. You can be a little bit more accurate than you will be if you're projecting further than that. And certainly the closer to today that we are is when we're more accurate. But it really just helps us see, is there going to be a big fluctuation in cash based on what we know right now for the next 13-week period of time. So that helps us stay in front of those things. And if we see something not looking right down the road, then we can make adjustments before we get there.
That's excellent.
Can I ask Seth a question?
Yeah, please.
I'm curious, Seth, because I'm putting my smaller retailer hat on. So I know that a lot of this feels out of grasp, or you're just wearing so many hats that to even find the time to do this kind of thing. Like, how would you do it? And maybe this is a question for everyone, but how would you suggest like a smaller retail get started on building something like that?
I mean, I think you can make it as simple or complicated as you want. And our systems, we have some in-house built ERP connected to an older, Great Plains, or it's not Great Plains anymore, but Microsoft Dynamics. We don't use QuickBooks. And so it can be a little bit complicated in terms of getting our data straight. But I think if you're a smaller retailer, it's really just thinking about, okay, based on what I know today about the next, what did I do last year to some extent? What is the recent pattern in selling over the last few months, which is, I think, typically a little bit more accurate than last year's numbers. What do we expect that we're going to sell? And just if you have the monthly number, kind of start thinking about how that's going to break down by week. And then what bills do you anticipate that are coming up? If you have merchandise on order, what's supposed to land over those next 3 months that you can project for? You might not get it perfectly right per week, but some of it, like merchandise, we don't have an exact number because some of it fluctuates, but we have an estimate. We're gonna have to disperse about this much cash to pay for that inventory. We're expecting sales tax to be this much over the course of the month. We're expecting our payroll costs to be this much. And if you do payroll, you can see that, you can do it by week, you can do it by every other week, however you do your payroll. Any of the other major items that you're gonna expend cash or disperse cash to pay off, make sure you have those accounted for. And it's not, it's not a P&L again, because like we talked about before, that's not an accurate cash statement, but it's like taking your cash statement and then projecting out moving forward those big expenses so you can see some sense of what it's going to look like.
You could probably get almost all that information right from your bank account, but just from your bank statement, and looking at where cash is going out, not having to have a fancy system for it necessarily. You can just see where the money's going.
Yeah. And I think the big items are the ones that you want to have a line item for. And, we wrap together some of the smaller expenses in one line item, but they don't tend to make as big of an impact on your cash position.
I like that, Seth. I think that's awesome. When I talk to other smaller retailers, I always just say, just start. And the first time you do it, you're probably going to go back and learn so much. Oh, we didn't account for this. We didn't account for this. But if you start the practice, then you'll just start to learn your business a lot better and how the cash is coming in and out. And I think to Jared's point, I think looking at the last year, yes, we have to trend on how sales are going now and what our current expenses are. But a lot of those more like quarterly or annual expenses, we're not going to know unless we look at the prior year. And so I think you have to look at what's happening now, but also what are our patterns that we go through, because it's easy to miss if you're not looking at like at least a year picture.
And I think your point about like starting the exercise and looking at, all of your expenses, that tells you a lot more than you'll realize if you're not doing that. It's just projections by the nature of the word, they're not going to be completely accurate, but the more you do this, the more accurate you'll get and the more confident you will feel in what you're doing.
Yeah. I'll also add, I think ChatGPT is a great resource. If you don't have any time and you don't have any other, you can't go hire people that have expertise in this. Like, just put your cash flow statement in ChatGPT and see what they tell you. You have to take it with a grain of salt, and you still have to know your business the best, but it's somewhere to start.
Yeah, I'm sure ChatGPT has tips that we're not going to provide here too about managing cash flow.
Sure. Bailey, you were touching a little bit on some of the leading indicators too, of things to kind of watch out for that could be coming down the road that can help you to stay ahead of things that could impact your cash flow. And are there any, for you or anyone else, are there any specific tactics or decisions that you all have made that have helped you to stay ahead with your cash flow and to just kind of keep on top of it in advance?
What I was speaking to in terms of this cash flow projections, the thing we do that's the most important, and understanding today what we think is going to happen before it happens.
We try to look at our sales trends to see how we can better align our advertising and to our sales response right now. One of the things we track a lot is consumer confidence, as our business tends to track consumer confidence a lot. Granted, it's backwards looking, but we can see trend lines with our retail sales, how it's been impacted by consumer confidence. So that's something we watch very, very closely.
I think there's lots of things we watch, but one that we haven't talked about is watching margin. Because when net income is thin, if margin goes up just a couple or goes down just a couple points or goes up a couple of points, that makes for a profitable month or a positive cash flow month for us. So watching margin, even just daily, checking in on it, seeing how it's going, and then if we start seeing a trend that it's going down, trying to get a handle on how our inventory is aging, what are our discount processes, what promotions are we running, because that truly, we could run a promotion that was just a little too aggressive one month, and that did us in for profit, and then cash flow following after. So I think margin is important to watch. I mean, you can watch days of cash on hand. So, that's a metric you can just Google and it'll tell you how to calculate it. But that kind of gives us a handle of how much cash we have and what our runway is. And then we really watch our break even point. We know how much sales we have to have in a month to break even. And usually, if we're breaking even, then that speaks to what our cash is doing as well. I know we talked a lot about how there's other stuff besides what's on the P&L that tells us about our cash, but we've got to at least start with breaking even if we're going to have a positive cash flow. So we all know that number in our company, and we're all pushing towards it. And especially in bad months, we're just hoping to at least hit break even. And if we're not doing that, then we know it's time to starting to get serious.
Sure. Yeah, those are some great things to keep an eye out on and really watch those numbers. I find that some, like you were saying, also just dig in, start. A lot of this is learning, paying attention to the numbers and spending time with it. I do remember the very first time I had to dig into a budget and really understand it in detail. I did do it with a tub full of cookie dough in front of me just to make the process a little more enjoyable. And I sat there for hours and hours eating cookie dough, I confess, while just going through numbers until I could really wrap my head around it, because spending time with those numbers, looking at all the different ways, how do you analyze it and understand it, and to your point, just starting really can make a difference in knowing where you're at and then helping to be prepared.
I'd like to add in when Bailey was mentioning margins, because margins can be critical, especially if you're a special order business like we are. We may have priced something in the past where there's now a price increase or a surcharge, or freight's gone up as a percentage, and all of a sudden you take that sale from your website, or someone came in and ordered something, and then you find out that fulfilling that order is actually you're going to lose money because your margin's now too low. So you got to always make sure that as you're getting these manufacturers notices for price increases or surcharges or freight is changing, that you're adjusting your pricing accordingly quickly.
Yeah.
To add to that, I think even instead of thinking about the margin as a percentage, you should be looking at how many dollars you're projecting to bring in as gross profit, because the margin percent, you could be running 45%, you could be running 55%. It's at the end of the day, it matters how many dollars you bring in. So make sure that you're translating whatever you're trying to accomplish with your margin to actual dollars, because the dollars are what cover the cost. And if you don't have enough gross profit dollars, then, if you're spending too much or your expenditures are too much, then the margin itself doesn't matter. It's how many dollars is that producing for you?
I think a good way to do that, if you can figure out how to pull this information out of your POS system, is figure out how much cash, look at a 12-month history of the cash that you're taking in specifically on collection for sales to your sales figure, to figure out like what that percentage is. And you can start to get an idea of how to translate your sales to actual like cash that's coming in the door from sales.
Yeah. And so kind of getting into a natural shift here in our conversation into some various tools and tactics and how to use them. And my next question for you all is, what forecasting methods or technologies are helping you to better predict and improve your cash flow? Are there any specific tools you're using to help you with that?
I'm always taking a look at our backlog of customer orders that we have deposits on that have yet to be delivered. And I always look at what percentage of down payment has been already applied, knowing that if my down payment percentage is running higher than historical, that when I deliver these sales, we're not going to be getting as much cash coming in. So I should know that the cash is already in the bank account. When I see that there's a large, when the deposits are lower, then I can project that there's going to be more cash coming in. And that's just one thing I use on a regular basis, weekly or daily, just to see what's going on out there. And just look at that as a quick tool, just to check what's going on. I can use that when I'm not needing to be as thorough of a cash flow analysis, just to do a quick spot check to see how things are going.
Yeah.
I don't know how helpful this is, but I just use Excel and I have a model that I've built for us, and I have some inputs and it tracks it, and then it kind of gives me a forecast of where we're headed. So I think the most important thing for retailers is coming up with a method that works for them and making sure they're comfortable with it and can use it and don't feel overwhelmed by it.
Sure.
And Excel is a powerful tool, right? People discount it. People think they need to have a, $30,000, $40,000 software. But realistically, if you know what outcome you're looking to get, every POS system exports to CSV, every accounting system exports to CSV. There's so much on the internet right now. You're trying to figure out how to do it. You can just Google, how do I make this formula? And it builds you this formula. And, we can take just as an accounting firm, sometimes we get, you know, like, let's say we do a Stripe reconciliation, right? Which is, could be 100,000 lines. And we can do it in an hour by just doing a query in Excel, right? And so, there's a lot of free tools available. You have 20 minutes, you go on YouTube and they'll show you how to do a projection in Excel, and you can download the actual templates already with the formula. So there's so much out there right now that's free, on the web. And, the other thing is you can also, if you're not sure, you can take that and throw that, as was said earlier, into ChatGPT and say, help me, this formula is not working, fix it for me, right? And if you know how to ask the question correctly, it will do it. Right? The biggest thing that people just think is that if you ask the question, it'll give you the correct answer, and that is not the case. So you have to be able to know how to tailor it, right? That's kind of the biggest thing with AI. It's not I gave it a half-ass answer, I'm gonna get a full, a quality response, kind of like information in is information out.
Sure. Dimitri, are there any types of dashboards you would recommend that people look at or spend some time with?
There's so many, so I don't recommend. I mean, look, the US runs on QuickBooks, Europe runs on Zero. Companies that have money run on, let's say, NetSuites or something, or some other large, Sage product or whatever. And so the answer is there's a lot of available information. They're all at this point good, right? This isn't 15 years ago where things were very limited. And I kind of feel over the next 12 to even 24 months, the ability to kind of micro analyze data is going to only get better and faster with AI, right? With especially what's come out over the last 4 to 6 months, what I'm seeing. I mean, we have software right now that's live that can do full reconciliations. It replaces bookkeepers altogether, right? Uh, it's not readily available. It's still glitchy, but at the speed it's been going, in the next, 12 to, is it 24 months, you're going to be able to find a app online that's probably 20 or 30 bucks where you can throw in all your bank statements, you can throw in all of your sales receipts and say, analyze this for me, right? You know, ChatGPT does that on a very remedial basis right now. But so like I don't have any good recommendations now because this environment is going to change in the near future by so much that I wouldn't spend any money on like very expensive software.
Well, that's good to know, because I'm sure there are companies out there that might not have a full robust finance team to go and do all this analysis for them or run reports for them. And then it's, how do you start? How do you dig in? And
90%, I bet you 90% of the people on here are using QuickBooks, right? Or some sort of,
sure.
consumer grade because they need it for taxes anyway, right? So
Yeah.
unless you're like really small and you're doing this on, nobody's doing a paper ledger anymore, right? So you're either using your POS system with a combination of Excel, or you're using QuickBooks because it connects to your POS and all of your bank accounts, right? That's there. It's just knowing how to use it, right? So recommendation is either if you're capable, go watch a YouTube video. If you're not capable, spend the $200-300 on somebody to train you how to do it, right? There's a lot of accounting firms, a lot of, even like we do it, where you train people how to use the software, right? But it's also available for free with tutorials online, right? And it's just knowing what you want to accomplish, putting that into Google, watching the video, playing around, right? And that's it.
There you go. Go help
Uh,
yourself with some videos and tutorials and
I mean,
yeah,
it's not what it was 10 years ago, right? It's
yeah.
it's just there's so much available information now that you can get very granular. Like as I said, you can we run reports for some of our clients that want, to know, forecasting. When we do forecasting for, let's say, if it's a retail client, we will throw weather into the loop, right? Because it's an important thing, right? If we can get any other data, right? For example, traffic data, we'll throw that in there, right? To kind of
Give us
understand.
even what's the weather for the day, what kind of traffic is going by the store, literally how many cars
Yep.
are driving
Yeah,
by.
yeah, yeah,
Okay.
exactly.
Mhm.
A lot of that is actually publicly available depending on where you live, right? And
Sure.
depending where your store is located.
Yeah.
So, or worst case scenario, you spend $100 and you can put a little device in front of your store that shows how many cars go. It's basically an automated clicker, right? And you can find trends, right? So if you're going to do some kind of marketing in your parking lot or something like that, you want to do it and it's costing you money. You want to do it on a day where statistically there's more cars passing by that location on that day. Like I know it sounds stupid, but a lot of people don't get to this level. They always think like very big, and they don't think about the simple, cheap, and kind of logical things that could affect their business.
Great.
I'll add to that. I think that, well, at least for us, we're on a point of sale system that we really can't get data out of easily, and I think that is true for some retailers. That they're great partners for us, but the software is a little bit antiquated, and that data is hard to get out of it. So we've hired a fractional data services firm that just all they do for us is help get the data out and get it into a format that we can do stuff with it. So we don't have, we're still small, so we're not going to hire like financial analysts. And I'm the one-stop shop for everything, but I'm not technically savvy enough to write code to get data out of our system. So that's a cost-effective way if you need that data and you need reports to set up and you can't get it out of your POS system is to find people who just do this fractionally and can, do contract work and get that out for you so that you can start doing some of this reporting and tracking
I
because
mean,
it's possible.
on that same note, if you lack the internal, you know, personnel to do the financial piece of this, hiring a fractional CFO
Mhm.
to help build some of these processes for you or build some of the templates in Excel, as Dimitri was talking about, it's a really powerful tool. You might feel overwhelmed in trying to get started with it. So maybe you need to ask for help, hire some fractional help for a period of time, even maybe it's not even a long-term thing, to get this stuff built, and then you can maintain it, as opposed to trying to figure out all your stuff. Because I know some smaller retailers are trying to merchandise, they're literally on their own for selling, they're also managing their marketing campaigns, and all of those things become overwhelming to then have to, if you're not great at Excel, to try and build some of this. While it's a really powerful tool, it's not, I mean, some people really, they see a page of numbers and their eyes glaze over, and it's just not the world they like to live in. So I think it's important to have somebody help you do that if you don't feel like you can do it yourself.
Yeah, and it's usually a 4 to 6 months project. I mean, we do it on different kind of levels across different industries. And from what we've seen, like we're helping right now a car dealership, right? They're in 4 states. They have Retail, they own their own. They've acquired a few brands and a few other things, and they're trying to understand, whether or not they're profitable by location, by brand, by type of vehicle, and things like that. And we started a project with them, I want to say like in December, and they're at a level right now. And it's they're using QuickBooks. They're not a huge they're very expensive cars, but not they don't do a lot of volume. Um, but they have 8 QuickBook files for their locations. We have an Excel that actually you can toggle on top and it'll change all the financials by period, by whatever, because Excel is able to do it, right? And it automatically pulls all the data from QuickBooks, right? And you can do it through, you can actually link, people don't realize you can link QuickBooks to like Google Sheets and things like that, and build it once, and the data updates automatically. And assuming you have and QuickBooks links to your bank account. So all you got to do while you're watching TV, just categorize properly your things. And in some cases, if you want to go granular, there's a little line when you put your category of, let's say telephone, you can choose what it is. If it's an employee telephone, if it's management, if it's whatever, and that gives you the ability to run it even more detailed, right? So it's just literally choosing an extra drop down and adding more detail on it, then that gives you even more, and then get that to flow over to, let's say, a report that either you built or somebody built for you that can get you what you want, right? And
Yeah,
again, I don't think everybody needs this, right? I think a lot of it can actually be done in whatever you're using, and you kind of at the base, at the base level, figure it out yourself. But you gotta, what everybody's saying here on this call is you gotta start somewhere and you gotta do something. Because if you're not doing it, then you're just going like this. You're going with your eyes closed and hope everything works out well.
right. No, I love this. It kind of helped take some of the intimidating parts out of it, makes it a little less scary. So it doesn't have to be overwhelming. So in our remaining time, I'd love to pivot over and talk about agility and resilience in this space. And what have you all done to ensure that your businesses can pivot quickly if unexpected disruptions hit, or be more resilient when during these times of uncertainty, or we have big disruptions coming down the road? How do we do that in relation to managing our cash flow?
I mean, we manage our cash flow and maintain a cash cushion that is one of our strategic resources to allow us to be agile. That allows us to take advantage of merchandise buys if there's a inexpensive offer on containers or truckloads or something like that. We also try to at the same time, we also try to make sure our inventory is clean so we have that cash available to be agile, especially now as imports are rising, domestics changing, everything's shifting and moving. Basically, it's almost reverse that our cash flow management is our asset that keeps us nimble.
Great.
I mean, I think it's also, understanding what are your big expenses and how variable they are, or what if something went really wrong or the wrong direction, where do you need to make hard decisions and be prepared for that? Not that you're going to want to do that, not that you're going to necessarily need to do that, but I think knowing the areas that impact your cash the most and being prepared to make the decisions as certain events might come up. I think it's an important part in staying mentally prepared, and therefore have the means to be agile in those moments. Otherwise, if you have a really poor sales month and you don't know where your cash is going because you haven't dug into this detail enough, you're not going to be prepared quickly enough to be able to make the decisions that you need to make to steady things.
I would say one thing that has helped us a lot is we have a really good relationship with our banker. We've had that relationship for a long time, and they understand the furniture industry and our economic conditions that we're in locally. But they know us, and they know that if we do get in a pinch, that we're good for it, and that we'll come back around, and that relationship honestly probably has saved our business a couple of times. Whenever, we had to close our doors for 3 months, whenever COVID came around, or other unpredictable things that we really all couldn't have forecasted for. I don't think any of us could have forecasted for shutting our doors for more than a couple of days, but that's been helpful for us. We've also, we used to be one location, then we became two, and now we're three. Just we expanded just in the last 10 years. So we're learning a lot of lessons as we go from one to three. But the biggest one is how we manage our inventory. I mean, that's where a majority of our cash is going, right? It is our inventory, and that's our biggest asset, that we're an inventory business. And so we've gotten really good at being strategic about when we place our orders, and knowing when they're going to come in. And to Seth's point, having that tracked out so that we can see, okay, this big container is coming in around this date. This is when we're going to pay for it. This is what we can expect. And so even just before, we almost like instinctively knew how to manage our inventory. It was just, we'd been doing it. We knew we could order. We didn't really have to track it. We knew we would be able to pay for it, but now it's really being strategic about when we order, how much we order, and the way we do it, especially now that we're getting to play with containers since we're a little bit bigger. And so I think really watching inventory, because to our point earlier, that's going to be an after income cash flow. That's something we're going to see on our cash flow statement. And so seeing how that swings and how that affects cash really makes or breaks cash for us at this point. If we don't plan inventory right, then we're done for the month. So
Makes sense. Is there anything that you're doing kind of culturally within your companies that helps other people get on board with this idea of, hey, we need to look at our numbers and pay attention, and other mindset shifts or cultural things you can do to help people get on board with understanding that numbers matter?
Well, I mean, I think it's a really important part of the equation. In our old days at Lax, we used to carry a lot of inventory, and we didn't turn it particularly as effectively as we would like. We also had another major asset with a lot of receivables, because we did a lot of in-house credit, more than we do today. And when we made some shifts to pay down debt so that we're doing less receivables, we had to shift where our cash was going, and because we didn't have these big assets that we're paying as consistently. So helping people understand why it's important that we had less inventory in stock, so that we didn't have we didn't have 60 days of every product that we sold, some stuff that didn't turn as quickly. We have a really big store, which not everybody deals with. One of our stores is 120,000 square feet of showroom space. So it's large, and you have to have enough inventory to fill it. So the stuff that we know is going to sell, that we have a strong history of selling, or that we think is going to be a winner, or whatever reason we've decided, we have all that stuff in stock, and we have more on order that's going to fill in when we run out of what we have on hand. But helping everybody understand that some of the items that we have, we won't, in the nature of this, sell a whole lot of them, but we will sell some of them. It's sort of the long tail of our merchandising mix. That there's a reason for that, because our sales team is very used to having everything in stock all the time. And so, I mean, inventory, while is an asset, it is the opposite of cash. You've made an investment, and the only way you get your cash is if you sell the inventory, right? So trying to get out of the things quickly that aren't moving, even if it means reducing prices and getting closer to the cost and just turning it back into cash, I think is a really important concept for people to think about. And I think helping your team understand that this business runs on cash, and there's a reason why you're making these kinds of decisions, is important. And I think people to understand the why, sometimes they don't buy in, especially if what you're doing today is all of a sudden different than what you were doing in the past.
Yeah. So we're down to I love that. Thank you, Seth. And we're down to our last 5 minutes here. I'd love to give each of you a chance to give one piece of advice that you'd give retailers to strengthen their financial position this year. So I'm just going to call on each of you and go around and see if you can share, what piece of advice would you give to our retailers? So Jared, can we start with you?
First
Is that
is
all
the
right?
best. I would say if you're not already looking at your cash flow statements, you don't have one, I would start with just by looking at where cash is going on a regular basis, look at those reoccurring expenses, and try to get a general idea of where your largest expenses are each and where they are each time of the year, where they fall on the calendar. So you have some idea of when your cash flow needs may be higher than average, and that might be a good place to start.
Awesome. Dimitri?
I mean, the simplest thing is start with somewhere, right? Start somewhere. Um, and don't look at it kind of where most people do, which is on an annual or period to date. Go a little bit granular, right? So if you're used to looking at your financials quarterly, look at them monthly. If you're used to looking at them monthly, look at them weekly or daily, and then just look at, the prior year, the year before, especially if your business has been around for a while, and just kind of try to understand your trends. And that could also mean speaking to the people on the floor, right? Speak to your salespeople and say, okay, you know, 3 weeks ago, I saw we had this spike. What happened? Do you know it? Did anything change? Right? If you're not there, right? If you're there, then just try to remember what happened, right? Because it can lead into, oh, this happened, so that means it can get you into the future. So you can kind of look into trends, right? It's a big thing. People don't realize it is.
Great, thank you. Bailey?
Everyone's already said such great things. I think one thing I would add that maybe I haven't said is I think sometimes we get so focused on expenses, and I think it's important to cut them as much as we can. But where we're going to get the most, squeeze out of the juice is making sure that our sales are staying up, and that we're tracking or that our margins are healthy, and that we're planning our cash flows. So I think a lot of times we get stuck in expense management and expense reduction, which is important, but that's not going to get us across the line.
Sure. Seth?
I'll add a little bit to what Bailey's saying, because I think that's a really great point that we didn't really speak to at all. It's not just where your cash is going, it's how much are you bringing in. So when you're looking at cutting costs, be really mindful and careful about cutting advertising expense. And because if you cut your advertising, while it is one of your biggest expenses, typically for a lot of businesses, or one of the bigger ones, if you cut the advertising, you have less customers coming in, then you have less revenue, which means less gross profit dollars to cover all of your expense. So sometimes it's something that people want to cut quick because it seems like a big item. And there's the old saying in advertising, 50% of your advertising works, you just don't know which 50%. So it becomes tempting to want to reduce that expense. But if your revenue falls and your gross profit falls, then you have to cut more expense, even more expense to make up for that. So that's, I think, just a caution. That should be one of the last things that you cut. You're better off running at a higher percentage of sales on advertising than cutting that and reducing your revenue even more dramatically.
That's one of the things we're working on as well, is trying to align that ad budget to sales. And it's a tough one because if you cut it and it cuts sales, it becomes a self-fulfilling prophecy. So sometimes I run it a little bit hot with a higher advertising budget to keep the top line growing.
Love it. Awesome. Really great practical advice. I mean, the only advice I have is to curl up with your numbers with a tub full of cookie dough. So that's all I got.
What flavor, Beth?
Oh, gotta go to straight chocolate chip.
Okay.
Chocolate chip cookie dough.
I'll try that next time.
It works, it helps. So this has been a wonderful conversation. Thank you so much to our panelists for everything, your advice, your insights, sharing your expertise with this group. Really appreciate it. We also want to just give another shout out to Synchrony for sponsoring our webinars. Our next webinar will be on July 17th. It is From Data to Dollars, Leveraging Data for Growth. So anyone wants to sign up, keep that in mind. And until then, keep inspiring your teams to drive toward excellence. Thank you for tuning in and trusting HFA to support your success.